All right, folks, let's talk about loans and debt. Two words that often evoke the same reaction, a cold sweat and a desperate urge to check your bank balance. But fear not, because understanding the difference between these two financial beasts is the first step to taming them. A loan, my friends, is like borrowing your friend's lawnmower. You need it temporarily. You promise to return it, hopefully in one piece. And maybe you even slip in a six-pack as a thank you. Debt, on the other hand, is like that friend who keeps borrowing 20 bucks and never quite remembers to pay you back. It's the lingering consequence of a loan, the financial equivalent of that awkward moment when you have to remind your friend they owe you money for the fifth time. Debt, my friends, is the Darth Vader to a loan's Anakin Skywalker. It starts with good intentions, the promise of a brighter future, a new car, a college education, that sweet, sweet pair of noise-canceling headphones. But without careful management, debt can spiral out of control, leaving you feeling like you're trapped on the Death Star of financial despair. So the key takeaway here is this: loans, when used responsibly, can be valuable tools. Debt, however, is a hungry beast that needs to be kept on a very short leash. And trust me, you do not want to be the one walking it without a muzzle. Let's rewind the clock a bit, shall we? Back in the good old days, and by good old days, I mean a time before indoor plumbing and the internet, people didn't have fancy credit cards or online banking. If they wanted something, they had to barter for it. Imagine this: you're a farmer with a surplus of sheep, and you really want a new plow. So you wander around the village, sheep in tow, desperately searching for someone willing to trade their precious plow for a couple of woolly creatures. It was a whole thing. Thankfully, someone, probably a very bored and entrepreneurial Babylonian, came up with the brilliant idea of money. No more lugging around livestock. Now you could just hand over some shiny coins and call it a day. This led to the first banks, temples that stored people's valuables and even offered loans. Fast forward a few centuries, and we have the Roman Empire, where banking became surprisingly sophisticated. They had checks, loans, and even branches popping up faster than Starbucks in a gentrified neighborhood. Of course, then came the inevitable fall of the empire, and Europe plunged into the Dark Ages, a time when financial innovation went to die. Thankfully, the medieval period saw a resurgence of banking, thanks in part to those clever Italian merchants who realized that lending money could be quite lucrative. And let's not forget the Industrial Revolution, which brought about factories, mass production, and a whole lot of new wealth, for some at least. Banks played a crucial role in financing this economic boom, providing loans to entrepreneurs and businesses eager to get in on the action. For centuries, the world operated on the gold standard. It sounds fancy, right? Like a VIP pass to the global economy. In essence, it meant that paper money was directly linked to a country's gold reserves. Think of it like this. For every dollar printed, there was a tiny chunk of gold sitting in a vault somewhere, backing it up. This system had its pros. It provided stability and prevented governments from printing money like it was going out of style. But it also had its drawbacks. Economic growth was limited by the amount of gold a country could dig up or hoard from others. And let's not forget the whole running out of gold problem, which could lead to panics and recessions. Enter the 20th century, a time of unprecedented upheaval and change. 2 world wars and a Great Depression later, the gold standard was looking a bit worse for wear. Governments needed more flexibility to manage their economies, and tying their hands to a finite supply of shiny metal just wasn't cutting it anymore. So they did what any sensible group of people would do in a crisis. They made things more complicated. They ditched the gold standard and embraced fractional reserve banking. In simple terms, this meant banks could lend out more money than they actually had in reserves. It's a bit like a magic trick, where money seems to appear out of thin air. In the wild and wacky world of finance, there's a bank for every occasion. Think of it like a financial buffet, except instead of questionable sushi, you're choosing between institutions that hold the keys to your financial kingdom. First up, we have retail banks, the friendly neighborhood pubs of the financial world. They're the ones you go to for everyday banking needs. Checking accounts, savings accounts, mortgages, the financial equivalent of a pint and a plate of chips. Next, we have commercial banks, the sleek and sophisticated cocktail bars of finance. They cater to businesses, offering loans, lines of credit, and other financial services that help companies grow and thrive. They're the ones mixing up the fancy cocktails of the financial world. the mergers, acquisitions, and IPOs that make headlines. Then there are investment banks, the exclusive nightclubs of the financial realm. These guys are all about the big deals, connecting investors with companies looking for capital. They're the ones throwing the lavish parties, where champagne flows freely and fortunes are made and lost with a single phone call. And finally, we have central banks, the stern but necessary bouncers of the financial system. They're the ones setting interest rates, controlling the money supply, and generally making sure the whole system doesn't go completely off the rails. They're the ones who can shut down the party if things get too out of control. Section 5. Debt as a Tool. Lessons from the Masters of the Universe. Now, before you start hoarding cash under your mattress like a paranoid squirrel, let's be clear. Debt isn't inherently evil. In fact, when used strategically, it can be a powerful tool for building wealth. Don't just take my word for it, though. Let's look at the masters of the universe. Those titans of industry who've amassed fortunes that would make Scrooge McDuck blush. Take Elon Musk, for example. The man, the myth, the meme lord himself. He's not afraid to take on debt, using it to fund his ambitious ventures like Tesla and SpaceX. Sure, it's a risky strategy, but it's also one that's made him the sometimes richest person on the planet. Of course, it helps to be a visionary genius with a knack for disrupting entire industries. Then there's Warren Buffett, the Oracle of Omaha, who famously built his empire by investing in undervalued companies. He's not a fan of frivolous spending or racking up unnecessary debt. Instead, he preaches the virtues of patience, discipline, and using debt strategically to acquire assets that generate income. The key takeaway here is that the ultra-wealthy understand that debt is a tool, not a crutch. They use it to leverage their investments, acquire assets, and ultimately amplify their wealth. Section 6. Interest rates and opportunity costs. Decoding the financial matrix. Listen up, because this is important. Interest rates aren't just arbitrary numbers that banks pull out of a hat. They're the puppet masters of the financial world, influencing everything from borrowing costs to investment returns. Think of them as the invisible hand guiding the flow of money. When interest rates are low, it's like a financial free-for-all. Borrowing money is cheap, encouraging businesses to invest, consumers to spend, and the economy to grow. But like a sugar rush, it can't last forever. Eventually, inflation rears its ugly head, and those low interest rates start to look less appealing. On the flip side, when interest rates are high, it's like someone hit the brakes on the economic party bus. Borrowing becomes more expensive, causing businesses to tighten their belts and consumers to think twice about that new car or kitchen remodel. This can help to curb inflation, but it can also stifle economic growth. Then there's the concept of opportunity cost, the sneaky little gremlin that whispers in your ear every time you make a financial decision. It's the cost of choosing one option over another, the potential gains you miss out on by not investing your money elsewhere. For example, let's say you decide to pay off your student loans early. That's great. No more monthly payments. But what if instead of funneling all your extra cash toward your loans, you invested some of it in the stock market? You might miss out on potential returns. Section 7. Good debt, bad debt, a tale of two borrowers. Now let's talk about the two sides of the debt coin. Good debt and bad debt. Think of it like this. Good debt is like borrowing money to buy a rental property. It might seem like a scary amount of debt at first, but if that property generates rental income that covers your mortgage payments and then some, well, that's a financial slam dunk. Bad debt, on the other hand, is like that impulse purchase you made at 3 a.m. after a long night of scrolling through online shopping sites. You know, the one you swore you needed but now sits gathering dust in the corner. It doesn't generate any income, and it's costing you money in interest charges. Not exactly a recipe for financial success. Here's the thing. Not all debt is created equal. Some debt can help you build wealth, while other debt can leave you drowning in a sea of interest payments. The key is to be strategic about the kind of debt you take on, and to have a solid plan for paying it back. This is where financial planning comes in, folks. It's not the sexiest topic, I know. But trust me, taking the time to create a budget, track your spending, and set financial goals can make all the difference. It's like having a roadmap for your money, guiding you toward financial freedom, instead of letting you wander aimlessly through the wilderness of debt. Section 8. Money creation. It's not magic, it's banking. Mostly. Ever wonder where money comes from? No, it doesn't grow on trees. Although, wouldn't that be nice? The truth is, most of the money in circulation isn't printed by governments. It's actually created by banks through a process called fractional reserve banking. Here's how it works. When you deposit money into a bank, they don't just stuff it in a vault and call it a day. Nope. They keep a fraction of your deposit as reserves, hence the name fractional reserve banking, and lend out the rest to other customers. Now, here's where it gets interesting. Those borrowers then deposit their loan proceeds into other banks, who in turn lend out a portion of those deposits and so on. This cycle of lending and depositing creates new money in the economy, like a financial perpetual motion machine. Of course, it's not quite as simple as that. Central banks play a crucial role in regulating the money supply, setting reserve requirements for banks, and using monetary policy tools to influence interest rates and control inflation. It's a delicate balancing act, like trying to keep a beach ball afloat in a hurricane.